Good afternoon. Thank you for being with us in this afternoon. My name is Kaira Rivera. I am the Managing Director of the Audit Department of Kevane, Grant Thornton. And today, we will be presenting the topic, Challenges to Consider in the Implementation of Accounting Standard Codification 606, Revenue from Contracts with Customers. Thank you for your time, and thank you for being with us in this presentation. It's important to mention that this meeting is being recorded. We will be sharing the recording and the slides at the end of the presentation. So let's get started. It's important to mention that this presentation does not constitute any kind of advice, but if you have any questions, feel free to use the chat of this presentation and make your questions. We will be summarizing all of them and we'll share with you the answers subsequently. This afternoon, Marisol Rodriguez and Janice Velasquez, audit managers from our department, will join me in the presentation of this topic. Before every presentation, we share and present our values, which are summarized in this word, which is clear. Clear for collaboration, leadership, excellence, agility, respect, and responsibility. We strive so that they are reflected in everything that we do. This is our website, grantthornton.pr, where you can find information, publications, and useful information related to the coronavirus COVID-19 pandemic. So we encourage you to visit our site and find out that useful information. Today, we will be discussing these three major points in our agenda. The first one, we will do an overview of the standard implementation and some peculiarities and subsequent changes that have occurred. We will go through the summary of the 5-step process for recognizing revenues and the challenges encountered during the assessment and the application of the standard. And also, we will discuss some of the impact that the pandemic has done to the implementation of the standards and resulting in the deferral of the pronouncement implementation. So I introduce you to Marisol Rodriguez, which will be commencing with the discussion and the overview of the standard implementation.
Thank you, Kaira. Good afternoon. In May 2014, the Financial Accounting Standard Board and the International Accounting Standard Board published their largely converged standards on revenue recognition. Accounting Standard Update number 2014-9, Revenue from Contract with Customer, and IFRS 15 with the same title. This new pronouncement created a new principle-based revenue recognition framework that will affect nearly every revenue-generating entity. The goals of the FASB and IASB have for this revenue recognition project were to improve and converge the revenue recognition principles under US GAAP and IFRS standards, and to develop guidance to enhance revenue recognition requirements, while also providing a more robust framework for addressing revenue issues. These standards will improve the consistency of requirements, comparability of revenue recognition practices, and usefulness of disclosures. The new revenue guidance applies to all contracts to provide goods or services to customers, except for leases, insurance contracts, financial instruments, and certain guarantees and non-monetary exchanges. The new revenue standards also affect other related accounting topics and create new disclosure requirements, such as contract modifications, right of return, licensing, cost to obtain or fulfill a contract, principal versus agent consideration, presentation and disclosure, among others. One concern entities have, mainly not-for-profit, is the applicability that this new standard has over contributions received. First of all, it is important to mention the definition of a customer and a contribution. The term customer is defined as a party that has contracted with an entity to obtain goods or services that are an output of the entity's ordinary activities in exchange for a consideration. And a contribution is a non-reciprocal transfer. A contribution is not given in exchange for goods or services, and its definition differs from an exchange transaction. Therefore, the FASB staff interpretation is that the contribution is not within the scope of Topic 606 and will continue to be recognized in accordance with other topics. It is important to mention that a not-for-profit entity might enter into transactions other than contributions, such as exchange transactions. A not-for-profit entity should evaluate whether transactions that are not contributions are within the scope of the Topic 606. As included in the new revenue standard, the objective of this guidance is to establish the principles that an entity shall apply to report useful information to the users of the financial statements. This new guidance was created with the purpose of remove inconsistencies and weaknesses in revenue requirements, provide a more robust framework for addressing revenue issues, improve comparability of revenue recognition practices across entities, industries, jurisdictions, and capital markets, provide more useful information to users of financial statements, and to simplify the preparation of financial statements by reducing the number of requirements to which an entity must refer. In summary, this new revenue standard created a new comprehensive framework for assessing all revenue transactions, eliminating inconsistencies and gaps that existed under prior standards, and enhance revenue disclosures by requiring more information about revenue. The revenue model's core principle is to recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. The core principle was established by the FASB and IASB and is the foundation of the entire revenue framework. In this new guidance are two fundamental questions concerning revenue. One of them is when to recognize revenue. That is, when an entity satisfies its obligation under a contract by transferring goods or services to its customer, and for how much revenue may an entity recognize. That is, in the amount to which the entity expects to be entitled to under the contract. For example, the expected amount. Although one of the purposes of the FASB's new guidance on revenue from contract with customer is to converge with that of the IASB, there are some differences between US GAAP and IFRS standards, such as the definition of the term probable, which under US GAAP, this term refers to a future event that is likely to occur, versus more likely than not as defined by the international standards. Another difference is that under US GAAP, the reversal of a recognized impairment loss on an asset is prohibited, while under IFRS, an entity can reverse a previously recognized impairment loss following their guidance for impairment of assets. Also, there are differences between the accounting policy elections relating to shipping and handling activities and the presentation of sales taxes collected from customers. Entities have the option of using either a full retrospective or modified retrospective method to adopt the guidance in the new revenue standard. The full retrospective application will take into account the requirements in ASC 250 with certain practical experience. Under the modified retrospective method, an entity recognizes the cumulative effect of initially applying this standard as an adjustment to the opening balance of retained earnings of the annual reporting period that includes the date of initial application. When using this method, an entity applies the guidance of this new standard to either incomplete contracts as of the date of initial application or all contracts as of a new contract after the date of initial application. Under the modified retrospective method, the new guidance need not be applied to contracts that were completed before the effective date. Entities that elect the modified retrospective method must disclose an explanation of the impact of adopting the new standard, including the financial statement line items and respective amounts directly affected by this adoption. The modified retrospective method provides entities relief from having to restate and present comparable prior year financial statement information. However, entities will still need to evaluate existing contracts as of the date of initial adoption to determine whether a cumulative adjustment is necessary. Therefore, entities should consider the typical nature and duration of their contract to understand the impact of applying this new standard and to determine the transition approach that is practical to apply and most beneficial to financial statements users. The full retrospective method may be most effective for entities that expect to experience a significant change, since information will be presented to the financial statement users more clearly. However, the full retrospective method will require a significant effort since the adjustment to prior reported results will change not only for the revenue recognized, but also the other direct effect of a change as defined in ASC 250. Entities should carefully evaluate the respective advantages and disadvantages of each of the transition methods before selecting their method of adoption. Here, we are summarizing some of the practical experience available for the use in the application and measurement principles within the standard. Disclosures similar to accounting policy disclosures are required if an entity elects certain practical experience. To mention some of these, for example, the practical experience for sales tax permits entities to exclude from the transaction price all sales taxes that are assessed by governmental authority and that are imposed on and concurrent with a specific revenue-producing transaction and collected by the entity from a customer. For example, sales and use tax and some excise taxes. The practical expedient for shipping and handling activities permits an entity to account for these activities that occur after the customer has obtained control of a good as a fulfillment activity, for example, as an expense. An entity may also elect to account for shipping and handling as a promised service. There are various practical expedients available for election during the year of adoption and others that have ongoing application. entities are not required to adopt the practical expedient in ASC 606, but adoption of these expedients is likely to lessen the burden of implementing certain requirements in the new revenue standard. An entity should apply the use of any practical expedient consistently to contract within similar characteristics and in similar circumstances. Now, we are going to discuss a summary of the 5-step process for recognizing revenue and some challenges encountered during the assessment and application of the new revenue standard. The new revenue recognition standard core principle is supported by 5 steps in the new revenue framework. The step 1 is to identify the contract with the customer. Step 2 is to identify the performance obligations in the contract. Step 3 is to determine the transaction price. Step 4 is to allocate the transaction price to the performance obligations in the contract. And the last step is to recognize revenue when or as the entity satisfies a performance obligation. As mentioned, the step 1 is identifying the contract with the customer. This step requires an entity to identify the contract with the customer. A contract does not have to be written to meet the criteria for revenue recognition. However, it does need to create enforceable rights and obligations. A contract can be written, verbal, or implied. However, this guidance applies to a contract only if all of the following criteria are met. The parties to the contract have approved the contract in writing, orally, or in accordance with other customary business practices and are committed to perform their respective obligations. The entity can identify each party's rights regarding the goods or services to be transferred. The entity can identify the payment terms. The contract has a commercial substance, and it is probable that the entity will collect the consideration to which it will be entitled in exchange for those goods or services. It is important to mention that under US GAAP, the probable threshold for collectability is defined differently from how it is defined under IFRS standards. We mentioned this earlier when comparing the differences between US GAAP and IFRS. If a contract does not meet these criteria at contract inception, an entity must continue to reassess the criteria to determine whether they are subsequently met. If the mentioned criteria are not met, the entity cannot recognize revenue until the consideration received is non-refundable and one or more of the following events have occurred. All of the performance obligations in the contract have been satisfied and substantially all of the promised consideration has been received. The contract has been terminated, or the entity has transferred control of the goods or services, has stopped transferring goods or services, and has no obligation to transfer additional goods or services. If none of these events have occurred, any consideration received would be recognized as a liability. As a practical expedient, an entity may apply this new revenue standard to a portfolio of contracts or performance obligations with similar characteristics if the entity reasonably expects that the effect on the financial statement of applying this guidance to the portfolio will not differ materially from applying this guidance to the individual contracts or performance obligations within that portfolio. When accounting for a portfolio, an entity should use estimates and assumptions that reflect the size and composition of the portfolio. Topic 606 includes this practical expedient to provide some relief from the burden of accounting for individual contracts. One of the major concerns entities have is when reassess collectability. This new standard requires an entity to evaluate whether it is probable that substantially all of the considerations to which the entity is entitled will be collected. This analysis is performed at contract inception, and it is not revisited unless there is a significant change in facts and circumstances. This evaluation should take into account only the customer's ability and intention to pay the consideration when it is due, and it might include evaluation of past experience with the customer and expectations about the customer's financial stability, as well as other factors. If an entity is required to reassess its contract because of a significant change in facts and circumstances, the criteria on this topic will be evaluated in the context of the remaining goods or services that has yet to be provided. The reassessment will not affect any asset or revenue that has been recognized from satisfied performance obligations. However, assets will need to be evaluated for impairment under other applicable guidance. For example, the guidance in ASC 310 on accounts receivable, or the FASB's new credit loss guidance in ASC 326. As mentioned, the step 2 is to identify performance obligations. The step 2 requires an entity to identify the distinct goods or services promised in the contract. Distinct goods and services should be accounted for as separate deliverables. These distinct goods or services are referred to as performance obligations. In the new revenue standard, a performance obligation is defined as a promise to transfer to a customer a good or service that is distinct, or a series of distinct goods or services that are substantially the same and that have the same pattern of transfer to the customer. A promised good or service is distinct and therefore a performance obligation if the promised goods or service is capable of being distinct, which means that the customer can benefit from the goods or service either on its own or together with other resources that are readily available to the customer, and that is distinct within the context of the contract, which means that the entity's promise to transfer the goods or service to the customer is identified separately from other promises in the contract. Entities may need to use significant judgment when determining whether the goods or services in a contract are highly interdependent or highly interrelated, or when such goods or services significantly modify or customize one another. This new concept may require entities to account for a bundle of goods or services as a single performance obligation, which may have previously qualified for separate accounting under legacy US GAAP. Now, we are going to discuss important matters to consider when evaluating if an entity is acting as a principal or as an agent. For an entity, the evaluation of whether the nature of its promise is to transfer the goods or service to the customer itself as the principal, or to arrange for goods or services to be provided by another party as an agent, is an important determination because the conclusion reached can significantly affect the amount of revenue to be recognized. If the entity is acting as the principal of a performance obligation, it will recognize revenue at the gross amount it is entitled to from its customer. On the other hand, if the company is acting as an agent, it will present revenue at the net amount. The first step in the evaluation of whether an entity is acting as a principal or as an agent is to identify the goods or services that will be transferred to the customer. In the amendment in ASU 2016-8, the FASB confirmed that the unit of accounting for evaluating whether an entity is acting as a principal or as an agent is not at the contract level. Rather, the principal versus agent analysis is performed for each specified distinct good or service that will be transferred to the customer. Accordingly, an entity could be a principal for certain aspects of a contract with a customer and an agent for others. The method of determining whether an entity is a principal or an agent under legacy US GAAP differs from how that determination is made under the new revenue standard. Under the new revenue standard, an entity is a principal if it controls the specified goods or service before that good or service is transferred to a customer. On the contrary, if an entity concludes that it does not obtain control of a good or service before that good or service is transferred to a customer, the entity is acting as an agent. That is, the entity's performance obligation is to arrange for another party to transfer the goods or services to the customer. As mentioned, if the entity is acting as an agent, revenues will be recognized net. Indicators as per ASU 2016-8 to determine whether the entity controls the goods or service before they are transferred to the customer are: the entity is the primary responsible for fulfilling of the contract, the entity has inventory risk, and the entity has discretion in establishing prices. Other indicators, such as the credit risk, were eliminated. Now Janice will continue discussing the next step under this new revenue standard. Thank you.
Good afternoon, everyone. Now I am going to start discussing step 3. After identify if contract exists in step 1 and identify each performance obligation in step 2, now in step 3 we proceed to determine which is the transaction price within those contracts identified. When an entity enters into a contract with a customer, they need to consider the terms of the contract based on their business practice when determining the transaction price of the contract. The transaction price is the amount that the entity expects to be entitled to as a result of transferring goods or service to the customer, and not necessarily the stated contract price. To establish the transaction price in the contract, there are several things to consider. An entity should consider the effect of variable considerations and the time value of money. Variable consideration is when customer has a valid expectation that the entity will accept an amount of consideration that is less than the price stated in the contract, or when there are other facts and circumstances that indicate that the entity's intention is to offer a price concession to a customer. When the transaction price includes a variable quantity, the entity needs to estimate the variable consideration using the expected value approach or the most probable quantity approach. The entity should also consider the time value of money, which is when a significant financing component exists, an entity will need to recognize revenue from the transaction at an amount that reflects the price a customer would have paid if they paid cash for those goods or services. Other things to consider are non-cash considerations and considerations payable to a customer. In order to determine the transaction price, if an entity agreed to a promised consideration in an amount that is other than cash, the consideration will need to be measured by estimating the fair value of the non-cash considerations at the inception of contract. Important that is at inception. If the fair value of the non-cash consideration cannot be reasonably estimated, then the consideration will be measured indirectly by looking at the standalone selling price of the goods or service promised to the customer in exchange for the consideration. There are some contracts that require an entity to make payment to the customer. Common examples are cashbacks, advertising arrangements, or vouchers. In most cases, those payments to customers reduce the transaction price, therefore reduce the revenue recognized. But there are other cases that may be a purchase or expense from the customer and are recorded as is. Important that when determining the transaction price, an entity does not consider the effect of customer credit risk. It is important to remember that collectability was addressed in step 1 when evaluating if a contract with a customer exists. Therefore, this issue does not need to be considered in this stage of the analysis. If collectability is not considered probable, then a contract does not exist, and therefore, this new standard does not apply. Later in the presentation, Kyra will be talking a little bit more about this topic when talk about the COVID-19 and the possible impact to the standard. Some of most frequently identified variable considerations items are performance bonus, discounts, rebates, refunds, credits, penalties, contingencies, price concessions, significant financing components, and incentives. So if your entity has contract with one or more of these variable considerations items, you need to estimate the variable considerations amount. If the amount of considerations in a contract is variable, to estimate the amount of these variable considerations, the entity can use either of the expected value method or the most likely method. The expected value method is the sum of probability weighted amounts in a range of possible considerations amount. An expected value may be an appropriate estimate of the transaction price if an entity has a large number of contracts with similar attributes. And the most likely method is the single most likely amount in a range of possible considerations amount. An entity will apply one method consistently through the contract and may include the use of historical, current, and forecast information. It is important to mention here that small and medium-sized private companies generally have less resources in terms of funds and experienced staff, and therefore they might need third-party assistance to help them develop the transaction price and variable consideration components. Therefore, we always mention that management should consider, first, look out the necessary third party early in the process and not try to rely on external auditors, since auditors cannot participate in management estimates and assumptions without impairing their independence. Also, management should consider that engage the third parties, such as valuation specialists or other experts, can be so expensive. So we recommend consider including additional money in the annual budget to cover those charges. Now, with the extension of the implementation date, companies have more time to evaluate the standard and the applicability in their business, and also have time to research for those third parties that can help or assist in the process. As a way of summary, we can say that fixed consideration plus variable considerations plus non-cash consideration less considerations payable to a customer equal the transaction price. So by definition, this should be the component of the transaction price. In step 3, it's important to remember to clients to exercise judgment in determining whether an entity is acting as a principal or as an agent. As mentioned by Marisol a minutes ago, The key to determine whether a client is acting as principal or agent depends on who has control of the goods or service before it is transferred to a customer. When a client has control of the goods or service prior to customer transfer, it is considered a principal and should recognize gross revenue. If the client does not have control, it is considered an agent and should recognize net revenue. Now, keeping in mind the definition of transaction price, let's move on to step 4. Step 4 is to allocate the transaction price. This step is less complex than step 3 and only applies when the contract has more than one performance obligation. When we have already calculated the transaction price of each contract, if the contract has more than one performance obligation, then the transaction price should be allocated to each separate performance obligation in the amount of consideration the entity expects to be entitled to for satisfying each separate performance obligation. The entity first calculates or identifies the standalone selling price of each goods or service underlying each performance obligation at the inception of the contract. Standalone selling price is the amount that the entity would charge if it were to sell the goods or service separately. Not necessarily is the same amount to the transaction price. The best evidence of standalone selling price is the observable price of a good or service the entity sells separately in similar circumstances to similar customers. When a standalone selling price does not exist, the estimate can be based on an adjusted market assessment. Use one of these 3 acceptable methods: the adjusted market assessment approach, the expected cost plus a margin approach, or the residual approach. Again, within step 4, client exercise judgment in some different ways. If there are complex contracts, the client will need to consider how to allocate the transaction price to each performance obligation, as well as the discount and variable consideration. The step 5, this is the last step in the 5-step approach, is recognize revenue. Revenue is recognized when or as the client satisfies performance obligations by transferring a good or service to the customer. Performance obligations are satisfied when the customer obtains control of the asset. It should be over the time or at the point in time. This assessment, again, requires judgment and establish how and when revenue is recognized. Performance obligations satisfied over time when the customers at the same time receive and consume the benefit provided by the entity performance as the entity performs. This basis typically applies to contracts for the provision of service, such as transactions processing or security services. The entity performance creates an asset that the customer controls as the asset is created. This basis typically applies in situations where the customer controls the working process as the entity manufactures goods or provides services. The entity performance does not create an asset with an alternative use to the entity, and the entity has enforceable rights to payment for performance completed today. This basis typically applies in situations where entities can create assets with no alternative use that have the right to payment for performance today, recognize revenue as the assets are produced rather than at a point in time. An asset does not have an alternative use if the entity is unable to redirect the asset for another use or to another customer. In the other side, a performance obligation is satisfied at a point in time if none of the criteria mentioned above for satisfying it over time are met. How to measure revenue over time? The method that can be used to measure entities' progress toward complete satisfaction of a performance obligation satisfied over time are the output method and the input method. Under the output method, revenues recognized are based on direct measurement of the value to the customer of the goods or service transferred today relative to the remaining goods or service promised under the contract, such as survey of performance completed today, appraisal of results achieved, milestone reached, and or unit produced or unit delivered. All these are examples of direct measurement of the value of the goods or services. Under the input method, revenues are recognized based on the entity's efforts or inputs to the satisfaction of a performance obligation. For example, costs incurred, resources consumed, labor hours expended, time elapsed, amongst others. Important here that a single method of measuring progress should be applied for each performance obligation satisfied over time and should apply that method consistently to similar performance obligations in similar circumstances. With this last slide of the 5 steps, we want to remark that all 5 steps of the revenue recognition model under this new standard should be applied in sequential order. This is other concern entities have upon the adoption of this standard. But as a general rule, an entity will generally be expected to apply the 5 steps in sequential order, unless a step is clearly inapplicable. For example, the contract has only one performance obligation, and therefore step 4, which is to allocate the transaction price to each performance obligation, does not apply. Therefore, in this case, this step is skipped and continue with step 5. But again, as a general rule, the 5 steps should be applied in sequential order. With this, we conclude with the summary of the 5-step approach, and now Kaira will continue talking about the impact of COVID-19 and how this affects the revenue recognition standard. Thank you.
Thank you, Janice. As we all know, the pandemic has affected businesses in different areas. It has impacted liquidity, working capital, human capital, purchases, transportation of goods, and others. For this reason, the board, committed in supporting and assisting stakeholders during this difficult time, in June 3, 2020, issued the Accounting Standard Update 2020-05 to delay the implementation of the standard by 1 year for entities that have not yet implemented the standard nor issued financial statements by June 3rd. For entities that have already adopted the standard, we can see an impact in some of these steps, and we will go through all of them to discuss some specific areas or items that have been noted that were affected by the implementation of the standard, specifically in steps 1, 3, 4, and 5. Beginning with step 1, identify the contract with the customer. Contract enforceability. Companies should consider whether this right to payment continues to be enforceable under COVID-19 impacted conditions. Without enforceable rights and obligations, a contract does not exist under the Standard 606. The other point noted under this step is the area of collectability. In order for a contract to be enforced, the presumption of collectability is needed. If collectability is no longer probable, revenue is adjusted prospectively. Entities should first consider any changes to the transaction price as a result of the COVID-19 conditions before determining whether collectability is probable or not, because collectability applies to the whole transaction price, which may vary from the amount stated in the contract if it contains price concessions or other variable considerations. The last point noted is related to contract modifications and combinations. Due to the fluctuating economic conditions caused by the pandemic, the scope or price of contracts may be altered to meet the needs of customers. Contracts may be renegotiated, and the entities should perform an analysis to determine whether the contract modifications should be accounted as a modification to the original contract or as a separate one. In step 3, determine the transaction price. Regarding price concessions, due to the downturn in the economy caused by the pandemic, entities may be more likely to grant price concessions to customers. If the customer is granted or expects a price concession, the vendor needs to adjust the transaction price. This adjustment is very important because it may impact whether the contract exists and how much revenue will be recognized to satisfy the performance obligation. Other variable considerations. In addition to price concessions, COVID-19 may impact the estimated amount of other forms of variable considerations, such as volume discounts, returns, rebates, refunds, incentives, performance bonuses, penalties, etc. If the transaction price of a contract is adjusted, the change should be accounted for prospectively in most cases. Also, it is important to evaluate if a variable consideration is constrained and therefore not included in the transaction price. Changes in the transaction price are typically accounted for prospectively. However, if entities disregard key economic information that is reasonably available when making those estimates for variable considerations, significant changes to the transaction price may need to be accounted for as an accounting change or an error in accordance with Standard 250. In addition, may also be more likely to, in this situation, to extend payment terms to help customers in these times. Extended payment terms may qualify as a significant financing component if the gap between the payment and the delivery is greater than 1 year. In step 4, which is allocating the transaction price, changes to standalone selling prices. Estimating the standalone selling price of goods and services is critical. It's a critical part of this step since entities allocate consideration to the performance obligations in a contract relative to a standalone selling prices. During these times, entities may notice significant fluctuations or changes in observable prices, which are likely to impact the selling process estimates. Although entities should not adjust the standalone price of goods and services in existing contracts, new contracts should consider or reflect selling prices according to the most current information available. Therefore, documentation here is very critical to justify standalone selling price estimates in the current environments. And we will see very different scenarios because of this fluctuating situation in the individual selling prices of goods and services. In step 5, recognizing revenues, specifically for recognizing revenues over time, this is a challenge. For contracts in which revenues are recognized in this way, it may change the timing of the revenue recognition. Entities must use the input or output method to measure the progress toward completion. Many projects are likely to be delayed by the pandemic, which consequently delays the progress of revenue recognition. The pandemic has affected many supply lines, which may increase the cost of certain materials. A change in material prices could impact the timing of revenue under the input method because the cost incurred will deviate from expected costs. All changes to these types of estimates should be accounted for prospectively. This is very important. For contract costs, some of the costs to fulfill or obtain a contract can be capitalized and amortized if they are expected to be recovered. If recoverability of this cost is questioned due to customers' default, capitalized costs should be written off as an impairment loss. As noted, the pandemic has affected even more the assessments needed with implementation of this standard. They were already demanding in terms of estimates, allocations, variable considerations, and now a more detailed look is needed and the scenarios are rapidly changing. So it's very important that care be given to this situation and the different scenarios occurring to give the proper look to this and have the proper documentation, which is very important. Disclosures are also super important, and the objective of the disclosure requirements related to these standards is to disclose sufficient information to enable users of financial statements to understand the nature, amount, timing, and uncertainty of revenue and cash flows arising from contracts with customers. COVID-19 has influenced or changed these judgments. And as I mentioned before, documentation is very important to support the disclosures and the numbers that will be reflected in the financial statements. The implementation of this standard has been a challenge. Nowadays, it has been even more with the impact of that the pandemic has brought. The final point of our goal is to have an uniform revenue recognition standard that has demanded tremendous efforts from companies and management. And Grant Thornton has the tools and we have the experience to help you. So management, owners, preparers of financial statements have the tools, have the information available to evaluate the different scenario situations that your business is going through. At the beginning of the presentation, we mentioned you that in our site, grantthornton.pr, we have information related to the COVID-19 and resources. And also, we are included an additional link from Grant Thornton US, in which also they have a site with a specific information related to this area and the impact that it may have in the company's financial statements. In the presentation, we are also included some of the resources that we consulted or we use as a support to do all this research and to get prepared to the changes that have been occurring related to this theme. So in the presentation, we will be including the resources that we consulted. As I mentioned before, we have the experience, we have the resources, we have the tools, and we are here to help our clients, to help the companies that need us, and we will disclose here, and you will have it in the presentation, the information about us. So feel free to contact any of us, and we truly appreciate your participation here, and seeking our support in the situations that you may have encountered in your day-to-day operations. Also, we have our publications and the mobile application that will also give you with information not only related to COVID, not only related to the specific standard, but with other changes that are occurring in taxes, in audit, in payroll taxes. So these are the tools. We appreciate your participation. We appreciate your time. You will be receiving via email a copy of the recording of the webcast and also the slides. And if you have any questions, please feel free to write it down in the chat of the webcast, and we will be answering the questions. Then via email, we will collect all questions and we will answer them. Thank you so much. Thank you for your participation. And as I mentioned before, we are here to help you. We are here. We are learning in this process. This is changing constantly. COVID has moved our feet, like we said, and we have to adjust day to day and learn from what is happening and share this learning with all of you. So thank you for your participation and have a great evening.